In this presentation, we will take a look at part one of an example problem related to a private college, where we will be recording transactions for a private college. We're going to have the information on the left side. We're going to be journalizing that information down below, posting that to the trial balance. The trial balance will be in order. We have the assets up top, then we have the liabilities in orange, we have the net assets, which will be in the light blue, then we have what would be similar to the income statement accounts in the dark blue. Now note, I know that the trial balance is a little bit small here. We will have the journal entry to the left. Hopefully, if you can't see the trial balance as well as you would like, it'll give you an idea of where we're going to be posting these to a trial balance. Many times, many courses only have basically a floating type of journal entry. We would like to be able to post those journal entries to some type of worksheet, as we will on the right, so we get an idea of what type of accounts we're dealing with, which accounts are going to be increasing and decreasing, the effect on the accounting equation, the effect on what would be similar to net income or net assets in the not-for-profit organization. So down below, of course, we're going to have the green 0 representing that the debits equal the credits, that we are in balance. We have the change in the temporary accounts, which are going to be the change in these dark blue accounts, which would be similar to net income in a for-profit organization, the change in net assets in the not-for-profit. The items that are currently in here, this is a post-closing trial balance from a prior time period, so this is not the first year of operations. In other words, these are the beginning balances. Now we're going to be entering the transactions for this particular period. Information then says we have the tuition charges totaling the $245,710. We have the scholarship of the $16,560, and we have the tuition waivers for scholarship achievement of the $5,210. Those are going to be the numbers that we will first start with for this first component. So we have the tuition and charges. Of course, we are an institution, therefore an educational institution. Therefore, those tuitions and charges will typically be revenue. Of those amounts, however, $16,560 was for scholarships that have been gotten. Therefore, we won't be receiving money, cash, for that part of the tuition total. And then the tuition waivers for scholastic achievement also is going to be a waiver. So that means that of this $245,710, we won't be getting any cash related to the scholarships or any cash for the waivers due to scholastic achievement. So when we record this transaction, the amount then going to the receivable is going to be, so the amount that we expect to collect, we could think of this as going to be similar to us basically issuing kind of like an invoice for a for-profit type of organization. Also note that we will be recording these transactions, basically lumping everything up, one transactions for the entire time period, representing the activity for that time period, rather than going through a whole set of transactions over a particular time period, so we can get through the information faster and hopefully concentrate on those areas that are going to be different in a college or private college setting, as opposed to some type of for-profit type of organization. Okay, so we're going to take this $245,710, subtract out the $165,660 minus the $5,210. That gives us the $223,940. That's the amount that the receivable will be increasing by. That's the amount of money that we actually expect to receive. Then the difference between that and the tuition fees without donor restrictions, which is our revenue account. So the revenue account, in other words, is going to be increasing by the total of the $245,710. So that's going to be a credit of the $245,710. The difference between the two, we're going to be putting to that tuition and fees, discount, and allowances. And that, of course, will add up to the $16,560 plus the $5,210, that being the $21,770. Again, we got the total charges of the $245,710, in essence being our revenue. That's going to be our revenue account amount. However, we're not going to be receiving the amount of that revenue related to scholarship and tuition. Therefore, we're only going to be getting the difference of the $223,940. That difference of the $21,770, we're going to be recording to the tuition and fees, discount, and allowances, which you could think of as kind of like a revenue account, because like a contra revenue account, because the revenue account's going up with a credit direction, and then the tuition and fees, discount, and allowances is kind of like that revenue that we're not really collecting on. So it acts like an expense. It's going to go up in the credit direction, but it's actually kind of like a contra revenue account. So if we post this out, then we're going to say that we have the fees, tuition and fees receivable, that increasing our receivable amount in the debit direction. Then we have the tuition and fees discount and allowances, that acting as basically an expense going up in the debit direction, but being more like an contra asset account. Then we have the tuition fees without donor restriction, that increasing here in the credit direction. Then the change in the net assets, or kind of like the net income number, is going to be that the 245,710 minus the 21,770. So kind of like the net income type of number, the change in the temporary accounts, the kind of like income statement accounts being the 223,940. Next, we're going to be recording the amount related to the tuition refunds. So we have a tuition refund. That's going to be this item. That means that we're going to credit cash. We're going to say that cash had been received. We are now refunding it. Cash is cash. Cash is going to do what cash does. Cash is going to be a credit. So we're going to credit cash. Where's the debit going to go to? Now, this is a little bit unusual for the private college, because we're not going to make another account as you might think of what we would do in a not-for-profit organization. We're actually going to reduce the tuition. In other words, note that at some point in time, this tuition account, the 245,710, was increased by the tuition that we are now refunding, therefore overstated. So we're now decreasing it. It has a credit balance, therefore we are decreasing it to make it go back down at this point in time. The reason that's a little bit funny is because oftentimes we'll create another account. Many times we don't decrease a revenue kind of account, we make another account, such as if it was a for-profit type of organization and there were returns and allowances. We typically don't decrease the sales account, revenue, sales, income type of account. We record it to a contra revenue account called sales and allowances or something like that. Here, we're going to take the tuition and fees directly and just and make it go down, which actually kind of makes more sense, or is more intuitive or easy to see, because we're in essence simply reversing what we did in the past, which was a debit to cash and a credit to tuition without the donor restriction. So it might have gone through a receivable first, but in essence, we're reversing this transaction exactly. Okay, so then if we post this out, the cash is of course going down. Cash is a credit balance. Cash is a debit balance account. It's going down in the credit direction. We have negative cash right now. Don't let that throw you off. Then we're going to say that we have the tuition and fees. It is a credit balance account. Revenue usually only goes up in the credit direction, this being an exception where it will be going down as we debit it, decreasing to the 234,330. Next, we're going to have the amount that's going to be related to the tuition waivers for students serving the school are accrued. So we're going to accrue the tuition waiver. We're going to assume that these students are working as basically TAs, and therefore we're going to record their expense in the instruction expense. So we're going to record them in instruction expense in the case that we're assuming they're helping the instructors. The credit then is going to go to the accounts payable and accrued liabilities. So this would be very similar to a similar type of an accrual for a normal kind of for-profit type of organization. Posting this out, we're going to be debiting the instruction expense. It's a debit balance account. It will be going up in the debit direction. Then we will be crediting accounts payable and accrued liabilities. It has a credit balance. It's going to go up in the credit direction. Here we have the cash contributions without donor restrictions. We have the pledges to be collected. We have the contributions to endowments. We have the collection of pledges receivable that were unrestricted. So we could think of these, of course, as separate types of transactions. We're going to be grouping them together here in one larger transaction. Let's see what that might look like. We got the cash contributions without donor restrictions. We know then that cash will be increasing. Cash has a debit balance, so we can then start off with the cash amount. So we got the cash up top. Now, the amount we're going to say is going to be last. I'll pick the cash amount up last. So we have it here, but just note that we're going to think about that last. Of course, it's not here. You can see it's not the 2,390. The credit then is going to go to the contributions without donor restrictions. So that's going to be like our favorite kind of revenue type of account, our favorite income statement or similar to income statement type of account, the temporary account, increasing the the revenue type of account, contributions without restrictions. So that's going to be down here in the dark blue area. Then we have the pledges to be collected. So these are going to be pledges to be collected. We have not yet collected these. Therefore, the transaction is going to be a receivable type of account. Up top is going to be going up, pledges receivable, in the debit direction. So that's going to be this item. And then the other side is going to be the contributions with donor restrictions. We're saying there is a restriction due to time. So the fact is we're going to basically record these pledges, these kind of promises to give us money. We're going to record them as we make the promise, kind of similar to a for-profit revenue recognition principle where we record revenue at the point in time we do the work. That's when we record a receivable and the related revenue in that case. In this case, we kind of did the work, right? We got the commitment, a pledge. However, there's still a significant, risk that we may not get the money, and therefore we're going to basically say that it's going to be a contribution, but we're going to have a time restriction on it in this case. Then we have the contributions to endowments. So the contributions to endowments, we're going to say it would increase cash. It's going to be part of the amount that will be increased in cash, and then we're going to have the contributions with donor restrictions. Contributions with donor restrictions with relation to, of course, the endowment. So it's a type of kind of like a revenue account, but it has the restriction. And then finally, we have the collection of pledges receivable that were unrestricted. So we had pledges receivable that are up top, a receivable account, an asset account. We're saying we collected some on that. We collected the 836 of it. Therefore, we're going to be decreasing the accounts receivable account by the 836. And the other side of that would then be going to cash. So then cash, of course, the top account is going to be, I would say, the plug being the credits minus the debits, the 2390 plus the 561 plus the 350 plus the 836 minus the 561 gives us the 3576 debit to cash. Recording this out then, it's going to look something like this. We're going to start off with the cash. So cash is up top. Cash had a credit balance because it was overdrawn. We're debiting it, so we're going back to zero. Hopefully we'll be breaking even in the cash soon before the bank gets really mad at us. And then we got the pledges receivable. The pledges receivable has a debit balance. Here it would be going up in the debit direction, but we're netting these two out. So the 836 and the 561 nets out to 275, which is a negative decrease in the receivable between the two. Then we have the contributions broken out between without restrictions, with restrictions for time, with restrictions to endowment. Those all increasing revenue type of accounts. They're increasing them in accordance with whether they have restrictions and the type of restrictions that they have. That then increasing the change in the temporary type of accounts, kind of similar to the net income type of number. Next transaction. Collections for tuition and fees. So we got the collections for tuitions and fees. It's kind of like our favorite type of transactions here. We're going to say that cash is going to go up because we collected on them. The credit then going to the tuition and fees receivable. So tuition and fees receivable then going down. So we're going to say cash is going to be increasing. So we had the debit of the 222,840. There was a credit balance. We are now debiting it. And so now we're back in the debit side of things, which is nice. Then we're going to credit the tuition and fees receivable. This is how much was in there prior to this. We're now going to be crediting the 222,840, bringing us down to the 1,360. Now we're going to say that there's a net deposit returned to students. Net deposit returned to students. We're going to credit then the cash and equivalents because we're paying it back of the $10, and then there was a deposit held in custody for others. Note that's going to be up here in our liability type of account. Deposits held in custody for others, it's a liability type of account. We had basically resources that are others are due to others, and therefore it's a liability. We're paying that off, similar to other types of liabilities like an accounts payable. We will then debit it to make it go down. Posting this out, we're going to say that the cash is going to be up top. Cash is a debit balance. We're going to then credit it, making it go down. And then we have the deposit. It has a credit balance in it of the 718. We will then debit it, making it go down to the 708. That, of course, brings us back in balance. No change in what would be similar to the net income type of number. Next, we're going to record the expenses. Once again, recording these items in a grouped format. So we're going to record the expenses that basically would be taking place throughout the time period in one type of transaction, so we can concentrate on those items that would be different in here in the college than it would for another type of for-profit organization. So we got the expenses related to instruction, academic support, student services, and institutional support. We're going to have expense accounts related to those in the dark blue area. Therefore, we're simply going to be debiting those for these amounts: the instruction expense, the academic support expense, the student service expense, and the institutional expense. Then we have the prepaid assets that were used of the 546. This is kind of like an adjusting entry. You'll note up top that we have the prepaid assets at the 1,378. We're saying that of those amounts we used or consumed 546. Therefore, we're going to be reducing the prepaid asset by the 546 that has been used, has been consumed. Expenses accrued, 4,791. So we have the expenses accrued that will be increasing the liability account for the payable and accrued liabilities. That's going to be this liability account. It's going to be increasing in the credit direction. And then if we take, of course, the debits minus the credits, we're going to take the 86460 plus the 23550 plus the 37790 plus the 28710 minus 546 minus 4791 gives us the 171,173. Posting this out, then we have up top, we've got the instruction expense. The instruction expense, taking that 17,400, debiting it by the 86,460 to the 103,860. Then we have the academic support. Academic support going from 0 up by 23,550 to 23,550. We have then the student services expense, the 27,790. Then we have the institutional support expense increasing in the debit direction as well. We then have the credit to the prepaid assets up top in the assets section at 1,378, going down as they have been consumed by the 546 to a balance of 832. And then we have the accounts payable and accrued liabilities, that at a liability account of 38,720. It then accruing, going up by the 4,791 to the 43,511. Finally, cash then decreasing for the period of that 171, starting at a debit balance of the 215,775.76 minus the debit balance, bringing the balance down to, minus the credit balance, bringing the balance to 44,603. We are back in balance. Down below, you can see the change in the what would be kind of like the net income type of numbers, all of the temporary accounts down below. As we had recorded all these expenses, we're going to say that some of these expenses resulted in the release in net assets with donor restrictions. So you'll note that as we went through these accounts, we have some assets that could be restricted from the amounts of donation. So if the money, when the money goes in, when we collect the revenue or record the revenue, if there are any restrictions, we record them at that time. Then we're going to unrestrict them. When do we unrestrict them? When we qualify for some type of performance that has been done that the restriction was there to do. We're going to say that some of these expenses were spent on items that are going to be qualifications to unrestrict some of the assets. Therefore, we want to go through the unrestriction process, which is going to be involving these two accounts down below. I'll read them on this side. These are the two kind of unusual accounts in terms of a for-profit organization to the private college. Net assets released, satisfaction of purpose restriction with donor restrictions, the same account without donor restrictions, the key term here being without and with donor restrictions. These two accounts will always be increasing the unrestricted amount, the one without restriction. That's the point of recording the transaction. Therefore, they're always going to go the same direction. I would think of them as kind of like revenue accounts, because the one that's going to be going up will be going up in the credit direction. And that would be kind of like increasing what would be similar to the net income number, or increasing a revenue type of account. The one that we would think of as going down, meaning the with restriction items, you could think of as a debit, like it's going to be increasing an expense, or you could think of it as a decrease to like a revenue type of account. Whatever makes sense, just note that when you record this to the statement of activities, the one without restrictions is always the one that's going to be going up. We'll be increasing the without restrictions column. The one with restrictions will be going down. We'll be decreasing the amount with restrictions column. We record the increase over here with a credit, kind of like we would to income, and then the decrease to the debit. So recording that out then, we got the amount with restrictions, it going up in the credit direction to here. The amount without restrictions going, you could think of down or up in the debit direction, bringing what would be similar to the net income down. No net effect on what would be net income, the change in the temporary accounts, because one went up and of course one went down.